June 12, 2026, the day the market collectively held its breath for the largest public offering in human history. This chart shows the absolute frenzy of those first few trading sessions. We start right here at the listing price of $135 a share, but watch the line rocket past $225, briefly touching a mythical $3 trillion valuation. But within days, gravity takes over. The stock plummets 20 to 25% from that peak, and you can see this massive red block here. That is roughly $600 billion in market capitalization, completely wiped out. For a lot of retail investors, this was baffling. They bought into a story about colonizing Mars, integrating advanced AI, and backing Elon Musk. Instead, they were sitting on immediate, heavy losses. A visionary narrative doesn't suspend the laws of finance. The stock market is a weighing machine, and it was actively grading the company's actual math. When SpaceX went public, investors valued it like a mature tech monopoly. They assigned it a multiple you would expect from a company selling high-margin software. But look at the sheer scale of these physical operations. Building orbital launch systems and maintaining massive launch complexes takes heavy, relentless capital expenditure. This is a hardware infrastructure company. Contrasting the $1.77 trillion valuation against earnings, stark red bars show a $5 billion net loss in 2025, accelerating into 2026. Because of this, Morningstar set a fair value threshold, this line, at $60 to $70, less than half the IPO price. That initial IPO price assumed years of perfect execution. It left absolutely zero margin of safety, forcing buyers to pay a massive premium today for potential profits that might not materialize for a decade. Then came the first major post-IPO shock. Management announced a $60 billion acquisition of the AI coding startup Cursor. To fund a deal that large, SpaceX didn't use cash. They paid for it entirely by printing new company stock. This visualization shows exactly what that does to your portfolio. When a company issues billions in new shares to buy an AI startup, the total ownership fractures into thinner slices. Existing shareholders instantly took a 3.4% dilution hit. Investors hadn't priced in a massive acquisition just days after the listing. Analysts immediately flagged the move and lowered their fair value estimates in response. Using stock to chase AI targets transfers value from existing shareholders to fund management's aggressive expansion goals. The hits to the balance sheet kept coming. Within days of raising up to $86 billion from the public market, SpaceX took on another $20 to $25 billion in new debt. Institutions quickly realized the risk of that leverage. S&P Global assigned the bonds a BBB credit rating, which sits at the absolute lowest tier of investment-grade security. But there is an even larger threat baked directly into the IPO structure, known as lockup expirations. Looking at this timeline, 20% of shares held by early insiders will unlock after the second quarter results. By December 2026, the padlock opens entirely, releasing a massive wave of previously illiquid supply onto the open market. Rapidly accumulating debt and the coming flood of insider shares underscore the speculative nature of the company's expansion strategy. Today, the stock sits trapped in the $150 to $160 range, hovering precariously close to its opening price, and leaving anyone who bought the peak holding a heavy bag. The hardware itself remains incredibly impressive. Starlink terminals and reusable rockets are genuine engineering marvels, but a brilliant technological achievement does not automatically equal a great investment. Treating a speculative, high-volatility growth stock like a guaranteed blue-chip compounder is a proven way to lose money. For the stock to ever justify that $3 trillion peak, they have to hit three massive milestones. Starlink needs to turn a sustainable profit, the AI integration has to actually generate revenue, and capital markets must remain willing to fund their ongoing cash burn. Never let a visionary narrative blind you to the gravity of the balance sheet, because eventually, the hype always surrenders to the math.